So once you reach a certain amount of net business income, it might make sense for you to do an S Corp election. One of the requirements as an S Corp owner is that you, as the owner, pay yourself a reasonable W-2 wage. Now, the IRS doesn't specifically determine what a reasonable wage is. One way to think about that is what you would pay someone if you hired someone to do the work that you're doing in the business. There are also some other suggestions, such as the 60-40 rule, where you use 60% of your net business income as W-2 wages and then the remaining 40% as distributions. The benefit of the S Corp is that you pay self-employment tax only on your W-2 wages and not on your distributions. With self-employment tax being 15.3%, that can add up to a ton of savings. But business owners are often surprised when they see their first payroll and see the way that the taxes play out. So we're going to talk through the tax implications and savings, potential savings, and then also show what that looks like when you're actually processing payroll. Here we have an LLC without an S Corp election with $100,000 of net business income. In this example, you would pay $15,300 in self-employment tax, 15.3% on all of your business net income. Once you do the S Corp election, and here we're using that 60-40 rule for the example, you would pay yourself $60,000 in W-2 wages. The remaining $40,000 net income would be distributions. The self-employment tax in this example would be 15.3% of the $60,000, which is the W-2 wage, and that would be $9,180. So again, in this example, using the 60-40 rule, your self-employment tax savings would be $6,120. So that's pretty significant, and that's with $100,000 in net income split 60-40. When you do payroll, if you are working with a provider, or even if you're setting this up yourself, one thing to keep in mind is, unlike a regular employee where they get hired for a set salary amount and then they just get paid that moving forward, you need to think about the number that's going to show up on your W-2. So in this example, we're starting payroll in April. This is a monthly pay frequency. So we've actually missed 3 payrolls. So if we put $60,000 as the annual salary, what's going to happen when we do payroll is you will have $5,000 in gross wages per month. But because, again, we are starting in April, you only have $5,000, and then there's 9 payrolls left in the year. So if you input your reasonable wage mid-year, you will not end up with that amount on your W-2. In this example, we would end up with $45,000 on the W-2. So what you need to do instead is take $60,000, divide it by the remaining pay periods in the year, and then multiply that by 12 months, because in this example, we're on a monthly pay frequency. So that would be $80,000. Going back into the payroll system, let's update that to $80,000. And then when we go to process the payroll, the gross wage is $6,666.67. So if we take that number and multiply it by 9, because that's how many payrolls we'll process in the year, that will get you to the $60,000 W-2 wage. So again, if you're setting yourself up for payroll mid-year and you're computing the annual salary for the year, you need to take your annual divided by the remaining pay periods in the year, and then multiply it by the number of payrolls in a full year. And that is the annual salary that you will input to get to that number on your W-2 for the current year. And then, of course, you have to remember on 1/1 of the following year to change your salary amount, because you will then have all of the payrolls for the full year. Coming back here to our payroll register, there's a lot going on. So here we can see federal withholding. So that's the federal income tax coming out of your check. Social Security, as an employee, you're paying half of Social Security. And then Medicare, you're paying half of that as well. So this is 6.2%. This is 1.45%. I'm going to bump over here to the right. And you can see this number matches this number. And that is because the employer pays half of Social Security. So here they're paying 6.2% Social Security on the wage and then 1.45% for Medicare. Keep in mind, you are both the employee and the employer in this situation. So your cost of payroll in this example is going to be your gross wage plus the employer taxes. Here, Social Security and Medicare coming out of your check and Social Security and Medicare paid as the employer. The combination of those two amounts is 15.3%. And so when we talk about the self-employment tax only being liable for self-employment tax on your W-2 wage, this is how that plays out in an actual payroll system. So half of Social Security and Medicare will come out of your check as an employee, and then half will be paid as an employer liability. Just as with any other employee, you will also have state income tax if you're in a state that has income tax. And in this example, we have New York, so we have state disability and New York paid family medical leave as well. Over here on the right, we have a couple of other employer taxes. One is federal unemployment tax, and that is going to be 0.6% on the first $7,000 that you pay yourself. So the cap here is going to be $42. One thing to keep in mind, there are a few states that may have a FUTA credit reduction at the end of the year. So you may see this $42 doubled to $84 if you're in a state with a FUTA credit reduction. But again, we don't know that till November. And then you have state unemployment tax. So each state has a taxable wage base, and each state will assign the employer an unemployment insurance tax rate. So this state unemployment tax can vary significantly depending on what state you are in, but you can expect to see an additional tax that you owe. And usually this tax will drop off throughout the year. For example, Texas, I believe, is $9,000 wage base. So the second payroll for this example, if they were in Texas, they would max out on that tax. New York, I'm not sure what the wage base is here, but check your state's wage base. You can multiply that by your unemployment insurance tax rate, and that will be the total liability for the year. Again, depending on what you're paying yourself and what state you're in and what their wage base is, you may see this tax drop off throughout the year, and federal unemployment will also drop off once you reach $7,000 in wages. So just to recap, with an S Corp election, you only pay self-employment tax on your W-2 wage, but the way that you see that is half of Social Security and Medicare coming out of your check and half of Social Security and Medicare paid as the employer, but you are both the employee and employer in this situation. Your total cost of payroll is going to be your gross wage plus the employer tax, plus any payroll processing fees if you're using a service provider. Oftentimes, business owners don't take into account the employer taxes when thinking about what this is going to cost them. So it's very important, gross wage plus employer tax, that is your payroll cost. If you are going to have health benefits for yourself as an S Corp owner, keep in mind that you are not allowed to take Section 125 deductions. Even if you have employees and you offer Section 125 benefits to them, you as the business owner are not allowed to take those Section 125 deductions. Instead, you would have the business pay for the health insurance premiums. And then at the end of the year, that amount gets recorded as taxable income on your W-2, but it is only subject to federal and state income tax. It would not be subject to self-employment tax, Social Security, Medicare, or the state unemployment taxes. So the tax benefits are there, but it's very important that you understand how it works, because again, a lot of times business owners are surprised about the amount of taxes either coming out of their check or the amount of taxes that they're paying as the employer. And then lastly, when you are doing the S Corp election, you have the option to significantly increase your federal and state withholding to cover the tax not only on your W-2 wage, but also on your anticipated net business income. And if you do bump those amounts up to cover that additional net business income, then you may not have to make those estimated quarterly tax payments to the IRS or to your state. But I would suggest consulting with your CPA or accountant to check with them how they suggest you set up your federal and state withholding. A lot of times we will be asked to set that up as a percent, but just depends on what your plan is and if you plan to continue making those estimated tax payments, or if you're going to try and bunch those in there into your payroll. So at the end of the day, the S Corp can be beneficial only if it makes sense, where you have enough business income that you can both pay yourself a reasonable W-2 wage and also have leftover net business income, because that is the benefit here, that net business income is not subject to self-employment tax. So if you don't have enough business income to pay yourself a reasonable W-2 wage and have enough left over to justify the additional cost and effort of processing payroll, then you're probably not ready for the S Corp election yet. Whew. Everybody clear? So at the end of the day, as always, if you have questions, please don't hesitate to reach out. We know that the S Corp election is a huge change for business owners when they start doing it. And usually there are a ton of questions involved, but that's what we're here for. We're happy to provide you an estimate of what it will cost you to add yourself as a W-2 employee, or answer any questions that you have about the S Corp and how it works with payroll. Feel free to subscribe, or you can find us online at valorpayrollsolutions.com.